All right, gamblers.
So gambler's fallacy is the notion that so if you have say like in poker, you lose 20 hands in a row, right? The gambler's fallacy says that, well, okay, because I lost 20 hands in a row, I must now have to then win 20 or 30 hands. Basically, it's what they call the due theory. Like I know in football, when you have a big losing streak, you're now due to win. So you lose 20 hands in a row. Now you're due to win 20, 30 hands in a row just to make up for it. That's the gambler's fallacy, and that's not actually true statistically. So what happens is, you lost 20 in a row. You're not necessarily going to win 20 in a row. Now, what's going to happen? You may actually lose another 30 in a row. But the longer you go out in time, the more time that goes by, everything will even out. You'll lose 20 now. You may lose 20. You may lose 30. After that, you're like, wow, why didn't my gambler's fallacy work? Well, because enough time didn't go by. If enough time goes by, then what happened, the curve will come back, and you may lose 20, you may lose 30. Then you may win 5, lose 10, win 16. You know what I'm saying? So it'll come back to basically the mean. And that's the whole thing that I was saying that I'm building is based on a level of regression to the mean. Everything has some sort of mean. And they're outliers. You have big wins, you have big losses, but eventually over time, everything kind of evens out to a certain number. So, that's what gambling.
I agree. And, in that space, I still say it's like, I agree. And I also know that when you get into the market, especially the more short-term you go, the less likely you are to really have a true process for winning. It's because the variables change too quick.
Right.
I do think the more experience you have in the market, there are certain consistencies that allow you to identify trends that make you a better investor than others. Now, those courses that are like, let's learn how to flip stock in 10 days, that's crap.
Right.
That's how like a lot of people get burned. But I do think over time, especially when you look at the buy hold versus the day traders, most day traders are cowboys and they don't know what they're doing.
But see, that's my point. That's what I'm saying. That's why I'm saying trading, which is typically short term, is not a skill. What you're saying is, you just said it. You said long term, people see more success. That's what I'm saying. That's investing. Trading is typically short term and, quick money, get in, get out. And to me, what I'm saying is that the market is on some levels right. I mean, we all visually can see patterns in markets. So there are things that are repeatable and things that are, I guess, quantifiable based on patterns. But on the short term, things are a lot more random. So that's what I'm saying. I don't think it's a skill because you can't put a skill around something that's random, that's generally random.
And that's also market timing.
Market timing is BS.
Yeah, that market timing. So, but then on the flip side, like you take market timing, right? And they say no matter what the catastrophic event that happens, immediately following catastrophic event, which also becomes random because you never know when the end is. You don't know what the bottom is. The end. Like no one knows until it happens, and then until not only it's happened, it becomes proven over a certain period of time. Like, yes, we're not going to, like, this was the floor because historical evidence shows it was the floor, not because we knew it was the floor at the time, because you don't know. Like, nobody can predict that number, but
you never know the floor after the fact.
I'm saying it's historic. So it's not future. It's like no one can say, when we hit this number, that's the floor. Trust us. We've done this a million times.
Right. Yeah.
But what people can say, and statistically, it's been proven, like if you miss the 10 biggest runs, the 10 days of the biggest runs after a recovery starts, that's the equivalent to missing like 3 years in the market. And so historically, that's been proven. 10 days. If you miss 10 days, it's equivalent to missing like 3 to 7 years in the market. And people try to time all this, but when they try to do this market timing thing, and I've heard people say this, even in this marketplace, I'm gonna wait till the floor hits before I start my buying.
I start my buying, Where is the floor? If everyone knew what the floor was, we would all be trillionaires. No one knows what the floor is. That's what I'm saying. And that's why I don't think trading works. The term trading works. Because again, you're trying to see the future, which no one knows. And then like I said, if you look at statistics will show that shorter term, the market is a lot more random than long term. So it's definitely, I'm saying trading is not a skill. It's like you said, it's gambling. But people sell people on trading as this monumental skill you can have to have income for the rest of your life. And how's that working out for most of these? folks.
For the base person, truthfully, I think the biggest thing of base person, somebody's watching this, base person, who's just getting into the market, trying to figure out what they're going to buy, what they're going to sell, what they're going to hold on to, what they're going to get rid of. Mindset is their biggest issue. Like being able to control their emotions.
Yeah.
Like they can learn all the strategies in the world all day, or like learn certain, if they emotionally can't withstand what it means to stay the course, they're going to lose.
I mean, that's what they call market psychology. I used to laugh at that. I used to think like markets, like when I was back in the day, when I was a quote unquote trader trying.
You and I used to talk about it.
Yeah, but we didn't know we were talking about market psychology. We were just talking trading. But I know, like when I got in the game, and I used to try to do the trading thing, and people would talk about market psychology. I was like, whatever, just follow the charts. It's all there. It's it's all in front of you. Man, as soon as that thing tanks 10, 20%, you panic out of it. That's market psychology.
Yeah.
It's rushing out of a trade or rushing into a trade without any sort of plan. I mean, this what we're going through right now. I mean, I've talked to many people. People are panicked. A lot of people have sold. I mean, right now we're 20% off of the recent low. Is that the bottom? Nobody knows. But a lot of people sold into that drop who are now underwater, and we've recovered 20%. So had they held, they would have recovered 20% or so of their losses. And had they bought, they'd be up. Yeah. So that's market psychology, being able to withstand a lot of these gyrations in the market that are, and this drop is historic. So a lot of people make sure I was looking at my account every day like, wow. But I mean, I know history. I know too. I've seen a lot of these, so I know kind of how this works. So, it'll come back like it always does at some point. When, I don't know.
I didn't even check my account. Like I didn't check it at all. Like when the market hit, I was like, it's fine. Like
I was going in and out because I was buying. So as it was dropping, I was going in making buys and making buys and making buys as it was going down.
The only time I went into my account was to buy. I did get out of one stock because the stock was a dud. But it wasn't because of the market. It was already a dud. This just gave me motivation to sell it.
Right.
But it's like when it happened, when all this was going on, it was like whatever. But also the thing that's killing a lot of people is they're running to the market now thinking, oh, I'm about to get this huge rush. I'm going to get my 400% next week.
Right. Next week. Right. Short term. That's the problem. Yeah.
It doesn't happen. Or they get a 5% move. I saw one person, they had a 5% move and they thought they were like killing it. They started like posting all this stuff about, if you would have got in at this price, it would be here now. I'm like, if you weren't here now, you'd be panicked and out of the market because you're a novice. And novice without the proper guidance, they get killed right now.
Yeah. Yeah. Oh yeah.
So,
yeah, I mean, anybody who's to me, like I've been telling everybody, and like if you have risk capital, money that you can lose, because again, history being your guide. If people look at 2008, 2007, 2008, 2009, remember we talked about. I saw Bank of America at $2. I think you got in at like $5 or $7. Yeah. Recently was at 40. But back then, people were like, can't touch it. It's going to zero. Life is over. The world's coming to an end. Same thing we're going through now. We're 20% off of the lows. Is at the bottom? Who knows? But the probability says those are way better prices to get into than where they were at. When the market was up, 30, 40% in the last year.
Yeah, and there's too. When I bought Google, people told me I was crazy. And this kills me. This kills me when potential investors say things like this. It's too expensive.
Right. Yeah.
For what?
Right.
So Google was at $500 a share when I first made the purchase into it. And that one share today is worth like $2,300. Yep. And I'm like, but you're trying to buy a $10 stock hoping it gets to 20. I bought a $500 stock that went to 2,000. So, I feel that return.
Right.
It's relative. It's what we talk about all the time. If people understood what relative really means in regards to your making money, make money for you, they would understand. Like, is every time people get $1, that's like getting an employee. You're either going to put that employee into immediately putting them on vacation, or you're going to put them into the assembly line and have them work to produce more goods to increase your money. And often, a lot of people watching this, they get these employees, aka dollars, and then they just put them to sleep in a savings account. And then they put them to sleep with a savings account, and they still pay the benefits. They still pay for vacation. They still they pay for lunch, and that's inflation. And so what they realize is when it's done, oh my gosh, not only were they not working, but I was giving them all these other additional benefits. I lost money because I don't have the buying power.
Right.
And if people understood like really like truly inflation and how it kills them, which we'll, you know, be discussing. So I think we ranted enough.
But on the last one, the thing you said about price, in one of the other groups, check with me, and somebody had asked about a price expense. You know, when is something expensive and when is it cheap? And it was, but the question was relative to basically market cap.
Yeah.
And I gave the example of CMG is at the time I think it was $740 per share. It had a market cap of $25 billion, whereas Bank of America had a share price of $25, but had a $250 billion market cap. So what that says is Bank of America is way more valuable than Chipotle, CMG.
Mm-hmm.
But you're looking at the share price, you might think, oh my God, CMG is so much more expensive. It must be much more profitable company than Bank of America. No, because you got to look at market cap versus just share price. Share price alone doesn't really tell you much of anything unless you bring in the number of shares that are outstanding.
That's just a number in isolation. And
yeah, right.
Anytime, you know, anybody who's watching this, you should never look at numbers in isolation, especially as it relates to investing, whether it be real estate, stocks, or anything else. If a house is $500,000 and that's all I tell you, what does that mean? If every house in that neighborhood is $3 million, then that's a bargain. But if every house in that neighborhood is $100,000, what are you doing? And so, you know, a $500,000 house means nothing. So a $510,000 stock, if that's all you hear and you go to a mindset of, oh, that's too expensive for me, or you know, and it's a difference. We're talking about a $10,000 stock. Let's be more realistic. If it's a $100 stock, $150 stock, and you're thinking, oh, that's too expensive, what is this normal like 52-week high or five-year return high? And I really look at 3 years. Like any stock I look at 3 years if it has that kind of history. I look at 5 just to kind of compare it to the 3, but I don't look at 6 months. I just don't. Like 6 months means nothing to me.
Right.
It could have been just good news. It could have been hint of a patent that was going to be approved but didn't get approved. It could be a lot of things that happens in short periods of time, but it's relative. This what Leon and I are talking about is the fact that numbers in isolation shouldn't mean anything to anybody who goes through Investor Education Academy. Like, if you all are engaging with Leon and I, then we're gonna drill into your heads. A number in isolation means nothing. And honestly, once you even get a number and it's not relative to something else, it still doesn't mean anything to us. So
like I would say, everything in the universe is relative. Everything. Everything's always compared to something else, because unless you have a comparison, like you said, it doesn't mean anything. And like we were saying about price, and I would tell people, you know, like we were talking about, price doesn't really matter. It's about value and where price is relative to where it's been. So what I use is I use the 4-year mean price of a stock to judge value, expensive or cheap. And that to me tells me, so, you know, if the mean price for the last 4 years is $100 and the price is at 60, to me it's undervalued. To me, that's a buy. If the mean price is 100 and it's at 110, right now the price is expensive and it's not a buy. So, but if I just see the price is 100, that doesn't mean anything to me. It's just $100. I don't know if it's on sale or if it's expensive. So, price alone means nothing unless it has to be compared or relative to something else.
Yeah. So everybody, we just wanted you all to hear, this is just what we talk about on a regular basis. Yeah. So literally we were talking.
We had issues earlier.
I'm just going to hit record. And so you got to hear us talking how we normally talk, but it's very real. I'd love for you to share it. Investor Education Academy is coming soon. Leon and I have been working diligently. And when you see things like this, it kind of gives you an idea of who we are and what we're about. So I thought it'd be cool to hit record and share it. So hopefully you guys can share it with somebody that you think will get value from it. But for today's theme, a number in isolation means nothing. We had technical difficulties getting on to do our live today, which is why we were just kind of going back and forth on Zoom. But we're going to try again tonight. And if we can't get on tonight, you'll see us tomorrow. So we look forward to seeing you all. I'll post this very soon, share it with a friend. Leon, anything in closing?
Just that technology is is not always your friend. You know, we had some technical issue trying to go live today, but so we just recorded our behind the scenes session. But no, that was pretty much it.
Yeah, but definitely check for us later on because we still have to give you our 2 stock picks, which we will deliver when we do our official live. Every week we give 2 stock picks, and this week is no different. If we don't get it out to you all tonight or tomorrow, we will post it. So we look forward to talking to you, and that's it.
Peace.